Hello, everybody. Just want to take a quick look at Bitcoin here and to tell you why, from a trading perspective, I would probably be a seller. I don't have a position in it, and I'm not talking about where it's going to be in a year, but I think there's a good chance that it's going to stage somewhat of a reversal now. And I will explain why. Now, trading doesn't really need to be complicated. Most people overthink it. They think that the great traders have these like super secret systems and they've come up with these great formulas. But most traders, proprietary trader is a trader who's essentially like a day trader, but they work for a firm and they trade the firm's money. Um, they're kind of like day traders, but they're not technically day traders because they can hold positions overnight. But a lot of hedge funds have proprietary trading style. That's their strategy. And this is the type of stuff that these people look at. And again, it doesn't need to be complicated. People try to overcomplicate it. Anyway, let's go take a look at Bitcoin here. And obviously, we've had this huge move over the last, gosh, I guess 4 days. I guess people are thinking Bitcoin is going to be safe. The banks are having problems, blah, 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 whatever, man. You know, one of the things that Bitcoin enthusiasts used to talk about is, oh, it's so great because it's unregulated. Well, guess what happens when things are unregulated? We have things like scam, bankment, fraud, uh, ripping people off, basically. But anyway, let me just talk about this indicator here. That's very basic, very simple. Most of the great traders that I was talking about, and believe me, I've worked with some of the top traders, like literally in the world. They are not overly complicated. They pay attention to maybe two or three different momentum indicators, and this is one of them. Now, momentum is a measurement of how far something has moved from time point A to time point B. Most of the time, a stock or a crypto in this case is within what would be its typical or normal trading range. When it gets above that, we call that overbought. When it gets below that, we call that oversold. Now, this is important because things that are overbought and oversold tend to reverse. They tend to revert back to the mean. There's a lot of trading strategies on Wall Street that are based on this concept of reversion to the mean. Now, what I have here, these two red lines, are what we call Bollinger Bands. And it's because someone named John Bollinger gets credit for inventing them. I mean, I'm not so sure he invented them. There were probably other people using them before, but he's certainly the guy who gets credit for it. Anyway, these are a really good uh, a really good indicator, I guess. What would you even call it? Would it be an indicator? Yeah, I guess it would be an indicator. And there's a reason why. Now, the top red line is two standard deviations above the 20-day moving average, this red line here. The bottom red line is two standard deviations below the 20-day moving average. Now, why is this important? Well, because statistics says that, or statistics and probability theory suggest that 95% of all trading should be within two standard deviations of the mean. So if something gets outside of this, it exceeds one of these thresholds to the top, well, that's going to bring sellers into the market. And if it exceeds this threshold to the bottom, that's going to bring buyers into the market. And a lot of these algorithmic trading funds or trading strategies or computerized trading strategies are based on probability and statistics. So it's not surprising that thing is so efficient or it works so well. You know, it's simple and it's efficient. So that's what we like. Now, notice down here we got below the Bollinger Band. So this was more than two standard deviations below the 20-day moving average. And what happened? We rallied. Up here we got above it. What happened? We sold off. Here we got below it. What happened? We rallied. All right. These are reversion to the mean. There are traders that see that it's exceeded these thresholds and it attracts them into the market. If they're a seller, they could push the price down. If they're a buyer, they could push the price up. Here we got above it and we had the sell off after. Here we got below it and we didn't really rally, but it did kind of give us a clue that this sell off was coming to an end, which it did. Same thing here. We didn't really sell off. Well, I mean, we sold off a little bit, but it kind of told us that the rally was coming into an end. Oh, things get overbought when people get too euphoric. Things get oversold when people get too bearish. And reading charts is all about understanding supply and demand and psychology. Now we can see here we got above the band, and this shows sometimes we can be overbought for a while. And we came back in here. So, this is another situation where it told us that this rally was maybe losing some steam. Now, people that use these Bollinger Bands to trade, I mean, there's a lot of different styles, but I'll just mention one, is not to make a trade when we get below the band in this case. Like you wouldn't buy it here. You would wait for it to get back within the band. You buy it when it's starting to reverse. You're not going to get the lowest price, but it doesn't matter. We are just here to make money. We're not here to be overly precise. And sometimes things can be overbought or oversold for a while. What the heck have we got going on here? All right, I'm going to go to my pen. Sometimes things can be overbought or oversold for a while, like we saw over here. So a good strategy is wait for the reversion back to within the band. So you would have bought here. Things that are oversold or overbought can remain overbought or oversold for a while. That's why I try to teach people a good strategy is to wait for the thing to actually revert. And once the reversion starts, you jump in. You're not going to get the best possible price, but it doesn't matter. You're going to stack the risk reward ratio in your favor. So here you would have bought here and you would have sold it up here. So, it's a nice little return there, about $1,000. Here you would have bought here and you would have gone up here and hopefully you would have had some good stop out strategy and you would have sold up here, but you would have bought here and sold up here. And you would have bought here, and now we're back above the band. So I think now is a good time to sell. So just remember, everybody, it doesn't need to be that hard. In the institutional trading world, where I spent pretty much half of my life, more than 2 decades, the great traders don't focus on silly things like Fibonacci retracements or Gann curves. They focus on the things I teach about. And what levels are important? What's the trend? What's the momentum? And what's the psychology? All right, so that's it, everybody. I hope you have a good day, and I would suggest using Bollinger Bands. At least spend some time looking at them, see if you can get comfortable with them, because they could be a pretty effective tool for a trader. Okay, thanks, everybody. I will talk to you soon.